Several years ago, Rich Buck, who I've worked with for about 30 years, Rich and I wrote a book entitled We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. And that book was focused on $12 million decisions that virtually every investor will make. They're either going to make it by design or they're going to make it by default. They're going to make it by chance or they're going to make it by choice. And obviously, we're here for the purpose of getting you to make the right choices as you sort through the decisions that every investor must make. And so what I want to do now is to go through those 12 decisions. In the resources part of this series, you'll find a link to a free copy, a PDF of the book, We're Talking Millions. And I not only hope you will read it, I hope you will share it with friends and family. But here's what we know about those 12 decisions. Each one, it's not just that it's a $1 million decision. It is that the decision will actually lead to an additional $1 million. So if a decision you make is going to lead to no return in the future, then I want to show you the simple decision that would lead you to $1 million so that you will have made $1 million more than nothing. So join me now as I go through these 12 decisions. And let's see what we can do to make sure that you take the right path. Now, before we get into all of the details about how to invest, what to invest in, how to build the portfolio, what expectations you should have for return, what kind of risk, all those things that will be very important to you being a successful long-term investor. But before we go there, I want to start with what I think is the most important thing to understand about investing, and that is the simple math of investing. I want you to understand the long-term impact of compounding money over time. So I'd like you to go with me through a couple of examples of how investors might have invested, the return they got, the money they took out in retirement, all of those things, they're going to be part of your lifetime and your math of investing. So be patient. Let's take a look at 4 ways you can see the impact of the math of investing. As we look at the first table, you will note that there are 2 investors. One investor, as he or she invests, is going to get an 8% compound rate of return during what we call the accumulation period. And then they retire and they start to take distributions. And these distributions are going to be the money that they live on, which they'll be able to have access to because they saved. So here's what they did. They saved $6,000 a year for 40 years. And they put that into a portfolio, really a fairly conservative portfolio I'll talk about later, but that portfolio gave them an 8% compound rate of return. And then they retired. And during their years of retirement. They reduce the amount of risk that they're exposed to. And instead of getting an 8% return, they get a 6% return, and they take out 4% a year to live on. So this is going to be a 30-year retirement, and then, in theory, they pass away, and they're going to leave money to their heirs. So the return on your investments over a lifetime will be how much you take out to enjoy yourself and how much you leave to others. So let's take a look at that set of assumptions. Okay, 40 years, $6,000 a year, $240,000 investment. At an 8% compound rate of return, that would be at age 65 worth $1,678,000. And then they would take withdrawals out of that as it continues to grow at a modest rate, and the withdrawals would be $2,624,000. And then at age 95, they pass on and they leave their heirs $2,833,000. So from how I think about investing, their return on the $240,000 investment was the money that they took out, that's the $2.6 million, and the money they left to others, that's the $2.8 million, for a total of a little under $5.5 million. Now, here's where this math becomes really important to you and to the rest of your life. And that is, if you as an investor could find an additional 0.5% return somehow, and by the way, that's why I'm here, is to show you many sources of that extra 0.5%. But if instead of 8, you got 8.5, if in retirement instead of 6, you got 6.5, investing exactly the same amount, taking out 4% of this slightly different return, I want you to see the huge impact of that extra 0.5%. So we look at scenario 2. At retirement at age 65, instead of having about 1.7 million, it's 1.9 million plus. And the withdrawals, instead of 2.6 million, it's over 3.2 million. And at death and passing what's left over to your heirs, instead of 2.8 million, it's over 3.7 million. So remember before, between the money that we received to live off of and what we left to others, totaled about $5.5 million. Now that number is almost $7 million. And the reason I wanted you to see that is because you have now added over $1.5 million to what you took out and what you left to others because you found a way to make a little extra money. Now, in the next table, we're going to assume instead of finding just 0.5%, we find 1%. And again, you're going to find out that's not all that difficult. And the only thing I want to point out in this second table that is important is that by doubling that 0.5% to 1%, you don't just double the additional money. In fact, when you look at the table and you see that the bottom line numbers, remember 5.5 million with the and 6%, but with the 9% and 7%, instead of the 5.5 million, it is almost 9 million. It is $3.5 million more. So in the first case, you got $1.5 million. Now we have 3.5 million. And that comes because you're compounding money on top of more money, and that builds over time. And that is a really important thing to understand. That is why we have to be so sensitive to make sure that everything we do in putting together the portfolio, that the profits, as much as you can possibly have happen, end up in your pocket and not somebody else's pocket. Now, I want to show a couple more tables here that have to do with following the math, because they're going to talk about a slightly different impact. Rather than you finding a way to make additional money on the investment, what if you simply put more money in? And so what I want you to see here, again, this is all theoretical. This is just the math of the process. If you made the 9% instead of 8% during accumulation, if you made 7% instead of 6% during the distribution, if you started the first year with $6,000, but each year you increased that amount by 3%. So in the second year, you would put away $6,180, and then in the next year after that, you would take and put 3% more in. So over the years, that difference is going to grow, and that's here on the table, because we have the one scenario where you did not add any money, so you had $240,000 at work, but in the other scenario, what we call scenario 4 here, your $240,000 is increased because of those 3% annual increases, and the total of the investments become $452,000. So you've added quite a bit of money, but I want you to see what happened to that money, because instead of ending up with around $9 million, you are now, because you added that additional approximately $200,000, you now have $12,443,000, an additional $3.5 million. So before you increased your wealth because of finding more efficient ways to invest, but in this case, it is about your efficiency as an investor. It simply means that you're building a bigger foundation from which it all grows from, and that will, in fact, hopefully multiply over the rest of your life. And I just want to show one more decision that would really represent you doing something as opposed to the market doing something for you. The other thing you can do is you can start earlier. Let's look at this last table. We assume in the one scenario that you put away over that 40-year period, starting at age 25, the $6,000 a year and increased it by that 3%. So you ended up having a withdrawals of 5.6 million almost, and at the end of your life, leaving 6.8 million to your heirs for a total return on your $452,000 of $12.4 million. But what if you waited? What if instead of starting at age 25, you said, "Hey, I can do this later. I don't have to worry about it right now. I got living on my mind right now." And so instead of starting at age 25, you started at age 30. You still did the same thing. You put in the money every year and upped it by 3%. But over that period of time, because of that first 5 years, instead of ending up with $12.4 million, you end up with about $7.8 million. In other words, that 5 years actually accounted for almost $4.7 million of that $12.4 million was because of that first 5 years. And this is almost hard to believe, but this is the money that gets there the earliest. That means it's going to compound for a longer period of time, and that is the impact. That is the impact of saving more. And by the way, we're also talking about making more on your investments. You put it all together. You start early. You add money. You get the 9 instead of the 8 and the 7 instead of the 6. And my goal is to show you here today how you might even make more. But now you get the math. And if you get the math, you know that even 0.25% would be worth grabbing if, in fact, you didn't have to do anything special to get it. Decision number 1 is so unbelievably simple and so easy to understand why it is $1 million decision. And that is the decision that you are going to save versus spend. Now, we know that the world generally is out there trying to convince you to spend. They don't want you to save because when you save, you can't buy the things they have to offer. And the reality is they're getting better and better at convincing people to spend. So that decision is obviously $1 million decision. The challenge is, how do we make it happen? And I truly think that Warren Buffett has the answer. It is such a simple answer, and it's in a quote. And it's in a quote I hope you never forget. Warren says, "Do not save what is left over after spending. Instead, spend what is left after saving." And in fact, 401k plans today, in most cases, when they have a new employee, have it set up so they automatically become part of that 401k plan, with money being taken out of their paycheck to go into the 401k before they ever see it. In the old days, what they were doing was they were making people opt in, asking the employee, "Would you like to take part of your income and put it away for retirement?" And it's fascinating because people didn't want to do that. After all, it was their money and they wanted to enjoy it. They waited all these years to finally be part of the spending class. But it turned out that by making people opt out of the program, most, over 80%, went along with that and did not ask to be taken out. So that is Warren Buffett's quote at work, no question. So it's a big challenge. Again, if you made a list of all the people who want you to save and invest, it would be a very small list. It would probably be your mother and your father and your grandmother and your grandfather, maybe your siblings. But as I said earlier, the rest of the world is really more interested in getting you to spend. And so I hope you find the discipline and the ability to adjust to what is going to be a lower cost of living, because you're not going to have all of the money. And by the way, Paul Hayes, in his book, Spending Your Way to Wealth, makes it very clear that saving really is about spending later. Spending later. And that's the key. And that is, as you will see, as you look at the other $11 million decisions, that is going to likely be a multi-million-dollar outcome over the long term. $1,000,000 decision number 2 is such an easy promise, if you will, or goal, because this one is about the decision to start saving earlier or waiting till later. And we addressed this briefly when we talked about one of those follow the math slides where we set it up so that one person started investing at age 25, and the other started investing at age 30. And during the 40 and 35 years, the annual contributions were just the same, which included $6,000 plus an increase of 3% each year. Here's the bottom line. In that particular case, that delay of 5 years cost $4.66 million to the one who started at age 30. And the amount of money that was invested during those extra 5 years was a total of $31,854. And the amazing thing, the hopeful thing about that original 5 years, that earlier period where they put away the $31,854, if the market went through the roof, okay, you were there for that amazing period of time, which is going to have a huge impact then over the coming same 30 years, 35 years that the other person is going to put in. On the other hand, let's say those first 5 years were just terrible. Well, if they were, that turns out to be good news too, because the bottom line is when your dollar cost averaging in and great equity asset classes are going to be selling for low prices, it means that during that 5 years you had a chance to buy up a whole bunch of shares that were going to, in the future, more than likely, from everything we know about the past, blossom and make you a lot of money. So $1 million, in a sense, here is a piece of cake. But I want to share another piece of cake with you that we might have some people who are a long way from starting investing, but are closer to the final years of investing. There is something very special we can do for a newborn child. And what we could do is we could invest on their behalf $365 a year. Let's just, for the sake of discussion, say we do that for the first 21 years. And a part of the deal is that then they will take it from age 21 through 70. Now, if you put that $365 a year, and obviously you can't do that in a Roth IRA when the child is just being born, but there are ways that you get it into the Roth IRA as soon as possible. But just assume that money, $365 a year, compounded at the rate that the S&P 500, Standard & Poor's 500 index, 500 largest public companies in the U.S., basically, that would be a 10% compound rate of return. Now, it could be more, it could be less, but at 10% between at birth and age 70, that will have compounded to be worth $3.166 million, $365 a year. But if you waited until that child is 10 and you start it then, and so instead of 70 years, it's 60 years. And instead of investing during those first 10 years, you spent that $3,650 in total on other things. The value of that portfolio at age 70, instead of being $3.166 million, it would be $1,218,000. So that is almost a $2 million difference because you waited that first 10 years to get started for that child. So whether it's for a child or a grandchild or yourself later in life, when you get started, the earlier you can get started, the bigger the pot of gold later in life. Well, there has to be one of these $12 million decisions that at least I could conclude is the biggest of all. And it's fascinating because so many people, young people especially, have chosen to take the path that is likely to lead to very small returns. In fact, returns that may not be much greater than the inflation that would be experienced, so that their real return over a 30, 40, 50-year period will be close to zero. And so this is a big one. And this one literally, for people who understand the difference between stocks and bonds, could in fact mean a $5, $10, $15, or even $20 million difference over time. And for this part of the presentation, I'm going to be referring to a couple of tables. One will be all about bonds, and the other will be all about stocks or equities. And here's what those words mean to those who do not know the difference between a bond and a stock, or what we would call, instead of bonds, some call it fixed income, and some call stocks equities. But there are two major kinds of securities. Bonds are debt instruments, an IOU. You take your money you're saving for the long term and you loan it to the U.S. government, or you loan it to public corporations. And over a long period of time, they promise. Now, that long period of time could be a year, it could be 30 years. But they will make a promise what rate of return you will get. So it's very safe Now, when I say it's very safe, the safest of all of the bonds would be what are called short-term government bonds or treasury bills. And here, as I look at the table that shows the returns for bonds or fixed income over the last 96 years, those T-bills have had a compound rate of return, a growth rate of 3.3%. And if you invested $100 96 years ago, it would have grown today to $2,172 through the end of 2023. If you bought bonds that had longer maturities, that the promise may be, let's say, 5 years or 7 years, that return goes up historically to 4.9%, and your $100 has grown to over $9,500. And the big return was with the longer-term bonds. Those could be 20 to 30 years. There, the return was 5.2%, and your $100 would have grown to $12,477. Now, here's why I can tell you from everything I know about the past. And let me make this very clear, that it is easy to know what happened in the past. I have said many times, there is no risk in the past. We always know what we should have done. And when it comes to bonds versus stocks, the first thing you need to know that in the case of stocks or equities, there is no promise of a return. In fact, the implied promise is we will go to work each day and try to grow the value of this public corporation to make it as valuable as possible. For you as a shareholder in the corporation, to the people who work for that corporation, for the officers who run that corporation, everybody is trying to make money, but there is no absolute guarantee. And so what you get instead of that guarantee is a percentage of the earnings. And if there are 1 million shares in that company and you own one share, when they have profits, you are in theory earning 1/1,000,000th of the earnings of that company. And for large companies, they can have a lot of shares and they can make billions and billions of dollars. And there are marvelous stories of companies that multiplied $100, for example, over a period of 96 years to multi-million dollars. And also, by the way, we have to know that there were a lot of companies that didn't make it. And that is one of the reasons that if you buy stocks one at a time, they're pretty risky, and I'll talk more about that in a second. But right now, I want you to know that when we look at another table, instead of looking at the bonds where there's a guarantee, we look at stocks or equities. How have they done? How would $100, what would it have grown to over the last 96 years? And in the S&P 500 like asset class, the compound rate of return was 10%. Now, that sounds in theory like doubling 5%. And remember that for 5.2%, the long-term government bonds grew to be worth $12,477. So you're thinking, I should get twice that. No. As a matter of fact, that is the magic of compounding at higher rates. And instead of $100 growing to $12,477, it grew to $948,715. And why don't young people invest in the stock market? Because they think it's risky, and it is risky short term. As a matter of fact, if we looked at the worst one-year performance of the S&P 500, it lost in 1 year 43.3%. If I look at the worst one-year performance of the short-term bonds, you basically broke even. Intermediates, you would have lost about 9%. Long-term bonds, you would have lost about 26%. But instead of getting a $12,000 return on your $100, think of almost getting $1 million. Now, 96 years is a long time. That's a lot of compounding. But compounding, when you're a 20-year-old over the next 70 years of your life, at 10 versus 3 or 5 is a huge difference. And yes, stocks are risky in the short term, but I want you to know that the very worst return over all of the 40-year periods since 1928, the worst return was a gain of 8.9%, and the best was 12.5. And that's about the most conservative group of stocks you can buy in the United States, the S&P 500. Now, we are going to talk later about some other kinds of stocks that instead of growing to $1 million, grew to $2 million. Or instead of growing to $1 million, grew to $5 million. Or instead of growing to $1 million, grew to almost $15 million. There is an overwhelming piece of information that you're going to see later in this presentation that will hopefully convince you that you want to have a little bit, at least, of these other equity asset classes. We'll get back to that later. But for right now, I'm just saying that those people who think they want to have their money in a super safe place because they can't take the volatility of the stock market, that over the long term, it has been a royal return. In conservative investments, you don't have to be aggressive. Now, when you hear this, will be 81 years old. And my wife and I have half of our investments in the stock market. In part of that in the S&P 500. Why only half? Because we also, unlike you, in many cases, have many years to work and save. We have no years to work and save. We're in the process of living off of this money. So when you're in your 70s and your 80s, maybe for some people even in their 60s, yes, they are going to be more conservative than having all their money in the stock market. But I'll tell you, if you're in your 20s or 30s, you ought to dig deeper into this decision, because it is obviously a huge $1 million decision. Number 4 is another one that is very, very simple to understand and understand why you would make the choice that I hope you will make. And also it is simple in how you can actually apply this decision. But this decision is about owning one or a few stocks or owning many. And the bottom line is this. Let's just, for the sake of discussion, say you own one company. A lot of people end up putting all of their investments, even in their 401k plan, into their company stock. And there are lots of reasons why that may not be a good idea. But the one aspect of owning one company is that you are at huge risk of that company failing. About half of the public companies that have started since 1928 have failed, and many that were really top of the heap, the best, most profitable companies to be in during part of their career ended up actually going into bankruptcy. And so the whole idea is to own many. It's called diversification. Now, this is one kind of diversification. We'll talk about another one in a little while, but this is the one that most people understand. It is risky to have all your eggs in one basket. And yet it's not uncommon for people who work for a company to have a high degree of confidence. A great one that is an example of that was Enron. Enron, the company, was actually recommending to the employees that they put all of their money into Enron stock. Didn't work out well at all. In the Northwest, where my wife and I have lived for most of our life, Washington Mutual was known as a friend of the family, and yet it turned out they weren't nearly as friendly as their advertising promoted, because they too got in financial trouble. Now, here's the good news. Now, I'm talking about what the academic community says here. The academic community says that if you own one stock, all your money is in one company, that your expected rate of return is the average return of all companies in that part of the market. For example, there are very large companies, there are very small companies, there are very growth-oriented companies, there are very value-oriented companies. Talk about that in a few minutes. But that as far as the academic community is concerned, since nobody knows how well a company is going to profit in the future, nobody, that the expected rate of return of one stock is the average of all the stocks in that group of stocks, in that part of the market, in what is often called that asset class. Large cap growth. Many companies in that group, that, let's call it an index, represents all of those large cap growth companies. Now, I will tell you, I've never met an investor who owned a lot of their portfolio or held a lot of their portfolio in one company, and that they didn't believe they were going to do better than the market. Of course they believe that. As a matter of fact, studies show that if people own a stock, they think it's worth a lot more than the stocks they don't own. That is just human nature. It's a bias that we have. And so the academics tell us, do not count on any one company. That in fact, and of course, some will do magnificently, we know that afterwards, but that to own many companies, in fact, own all of the large cap growth companies, own all of the large cap value companies, that will get you the average return of all those companies, which is without the risk of all of them going broke, because the individual company can always run into a catastrophic event. So that's a pretty easy fork in the road to give advice. It is a little more difficult for people to take it because many of us think we have a sense of something that's going to happen. I have a dear friend who I can't say that he has all of his money in Tesla, but I think he has a lot of his money in Tesla. And it doesn't matter what happens to the stock. He just knows it is, in the long run, going to be a huge, huge company. And I can't argue with him because I can't know the future. But I do know the prudent thing to do, because I do not need a home run because I've been a good saver. If somebody just doesn't have the ability to get it all together and have enough money in retirement without speculating, maybe they're forced to do such a thing. And then, of course, in order to build your portfolio so it has many companies, the industry has made that dirt simple. They have created, in fact, they first created in the 1920s, the mutual fund. And since then, that industry has grown and now manages trillions and trillions of dollars being managed for people as a group. So if you want to be in the S&P 500, you can go to Vanguard, you can go to Fidelity, you can go to Schwab. They all have an S&P 500 fund so that you can own all 500 of those companies. And then there are mutual funds that specialize in the sectors. And if you wanted to invest only in technology companies, you could do that. I am not recommending that. And I'll get to that later. I don't think you need, again, to become overly aggressive to get a really great return. But mutual funds, from everything that I know, is probably for 99.9% of the people who are going to come across our work, is going to be the right way for them to invest. My job in the coming million-dollar decisions is to make sure you know which are the ones that are likely to lead to the largest returns for you and your family. So in the fourth million-dollar step, we went from having one company to having many, and decided that the most efficient way to own many companies all at one time are to put your money into a mutual fund. And a mutual fund is nothing more than a legal form of business that allows the managers of the business to manage the money for tens of thousands, hundreds of thousands, maybe in some cases even millions of people who want to have the manager put together the portfolio for them as investors. Now remember, the mutual fund is there so you don't have to pick them. The mutual fund picks the stocks that are going to be put into the portfolio. The interesting decision for you is, what can you do to either make more money or reduce the cost of whatever somebody's doing for you, because all of these mutual funds have some sort of expense ratio to run them, to operate them. They call it an operating expense ratio. And they also have some sort of a marketing cost to reach the public, to let them know that they are there to work for you. And I want to talk about both the operating expense and the marketing expense. That's called, by the way, typically when you pay for that marketing expense out of your own pocket, this is important. If you pay for the advertising, if you pay a broker to have you sell the fund to the investor, that is a commission that is typically called a load. And that means that people who buy that fund are going to pay a fee to get into that fund. Now, today, for equity stock funds, that is typically 5.75%. When I first came into the business in the 1960s, that was basically a 9.3% commission to get your money placed in the fund. And what that means, whether it's 5.75 or 9.3, what that really means is that amount of money that pays that commission goes into the pocket of somebody else, whether it's a mutual fund sales force or it goes to some marketing organization. Wherever that money goes, I do know one thing, it's not going in your pocket. And it means that that money is going to grow in somebody else's pocket forever. And so we have to remember that the people who sell these load funds, they may tell you it's only a 5.75% commission one time. You're not going to have to pay it more than once. But remember what that means. It means that on a $10,000 investment, $575 is working somewhere else instead of working for you. Now, what's important to understand here is there is another decision that you can make. And that is that you can invest in a no-load mutual fund that does not have a commission. Now, the mutual fund companies, they advertise to you. You will see their ads on the internet. You will see it in magazines, or you'll see it on TV. But the difference is it comes out of that marketing expense, comes out of the pocket of the management company that manages the fund. So when you put $10,000 into that fund, it all goes to work. Now, they don't work for free, the mutual funds. But what is fascinating is that there is this second expense level that is there forever. And that is the cost to operate the mutual fund. Some mutual funds have expenses of 1.5% a year. Others have expenses of 0.02%, 5/100, 10/100, 20/100, but a fraction of that 1%. So when you buy a fund, it is possible you will buy a fund that has a fee to get in, a commission, a load. And that 5.75%, these are equity funds, and that's a typical expense ratio for that load. That will take that money out of the portfolio forever. And what is left will now have to bear the cost of the regular operating expenses. What are the operating expenses? Well, that would include the legal fees, the accounting fees, the trust fees, the administration fees, printing of the prospectus, all of the things that have to do with the day-to-day running of the fund. And if you get into a mutual fund that charges you 5.75, and then on top of that, charges you 1% a year to manage the fund, that means that you, in essence, are going to have about 1.5% right off the top every year for the rest of your life. Now, where does that 1.5 come from? Well, when you paid the 5.75%, that is the equivalent of earning 0.5% less on your original investment. Remember, the S&P 500 compounds at about 10%, or at least it has for the last 96 years, sometimes more, sometimes less, but the long-term return is around 10%. So if you put $10,000 in, but only $9,500 goes to work, it means if it makes 10%, it has in essence made a 9.5% return on the $10,000 you put in. So that is going to be impacting you every year because you start with less. And then if the fund charges 1% operating expense between buying and a load fund and being in what is an expensive fund, you are taking a huge hit. Remember, my discussion about the math of investing showed a 0.5% difference in return can mean more or less an extra 1.5 million or 1.5 million less, if you recall those tables. But now we're talking about 1.5% between the operating expense and the marketing load or commission that you paid to get in. And the thing you need to know is that instead of, in essence, possibly leaving $3 or $4 million on the table because you paid the commission and you paid these very high expenses, the choice is easily available to you to get that money into a very low-cost mutual fund that is what they call a no-load mutual fund. It is commission-free. And as I said, the management company will spend the money to make the marketing ask for people to put into that fund. But it comes out of their pocket, not yours. And it comes basically out of the operating expense. But if you pick a mutual fund that has a very low operating expense and no commission to get in or to get out, that's both at both ends, that's important. That means that you are making almost an additional 1.5% a year because you were a good shopper. And access to those no-load funds, the lists, they're available at Morningstar.com. You can go look at load funds and no-load funds, and you can look at their performance, and you can look at what kinds of things they own, and what are all of the internal operating expenses. In fact, they even will tell you whether it is a mutual fund that has that generates lots of capital gains taxes and dividend taxes, things that will cost you additional money above and beyond just the raw ownership of the fund. So there's $1 million bonus for you if you take the time to find the funds that are no load, and you take the time to find the no load funds that have low expenses. That combination is a huge winner for you, and it's one of those gifts or those advantages that keep giving for the rest of your life. So the expenses in the mutual funds that you're likely to get involved with are a big deal, whether it's the cost of buying those funds or the cost of having those funds managed. And just understand, a smart buyer that has the ability to look at the grocery store at a shelf of different products that you might buy, if you are able to make the difference, to tell the difference between the higher price spread and the lower price spread, believe me, you're not going to have any problem once you take the time to start checking out the mutual funds. But I'm going to make it really easy, because in the next $1 million decision, I'm going to narrow this down to just a handful of funds that are likely to be in your best interest. In decision number 5, we came to two very obvious forks in the road. In one case, it had to do with the expenses of selling, marketing a mutual fund, and who was going to pay for that. And then the second decision was whether to buy or invest in a mutual fund that has high operating expenses or low operating expenses. It's just as simple as that. Well, as we move into $1 million decision number 6, we come to an equally obvious decision, I think, about the kind of a mutual fund we're going to put our money into for the long term. Now, these are very distinct, they're very different kinds of mutual funds, and it has to do with how they manage the mutual funds. It's not whether they hold big stocks or small stocks or international stocks or U.S. stocks. It's about what are the goals? What is the object of the work that the managers are doing? And they are opposite ends of the spectrum in terms of what you are going to get in terms of return and expenses and all sorts of things that will be part of your bottom line. And of course, I'm rooting for the better bottom line. So let's see, as we come to a fork in the road, the choice between putting money into actively managed mutual funds that the manager's goals are to buy the best companies, to look through all of the big companies in the U.S. and only hold the 100 or 200 companies they think are going to produce the best return. And they watch those companies carefully. And if it looks like one of the companies for some reason is peaking out and is likely to be going down a lot, then maybe they'll sell that position and invest in something else. And in fact, the shareholder may even believe that the manager is going to try to get out of the market and move to cash if the whole market is going down, as an attempt to protect the investor. But basically, the managers, whether it's how they select stocks, how they select when to get in or out of the market, what is called market timing, these active decisions they make that force the movement of money in and out of different securities, that is called active management. And at the other end of the spectrum, we have passive management. And that passive management is best known as index funds. And what is different about index funds is there is absolutely no attempt to get a better return. The whole attempt is to build a portfolio that represents all of the stocks in this particular equity asset class, and to do the very best they can to meet, not beat, but meet that return that comes without any trading, without any buying and selling in order to add extra money to the portfolio. Now, it is normal for people to think that it would be smarter to put your money with people who are trying to beat the market. And they're smart people. I've met a lot of them. They are very smart people. They know a lot about investing. But the reality is, from all of the studies that have been done of active versus passive, that the probabilities of success are so much higher in the passively managed portfolio. To try to get the return of that asset class. Not better, not worse. Well, it would be maybe a tiny bit worse because they're going to charge some very small fee. Because the people who run the actively managed funds, the first hurdle that you have to get over is you got to pay those people a lot of money to do the active management. And there is no question these people want to beat the market, because if they could just beat the market, then they could get billions and billions of dollars under management. And at their high fees, that would make them a fortune. On the other hand, if you look at the studies that are done, and there's a study done, updated every 6 months, it's the SPIVA, S-P-I-V-A report. It will tell you over the last year, 5, 10, 15, 20, how many actively managed funds have been able to beat the market to get a better return. Now, the academics will tell you that just as a random event, you'll have some that will do better than the market. Even if you just throw darts, you'll have some dart throwers who will do better than the market because they will happen to land on some companies that did better within that market. But that about 1 out of 10 or 1 out of 20, depending on the equity asset class, over a 20-year period are able to beat that benchmark. And the rest underperform. And of course, this is the risk with an actively managed fund. It may be that you'll get lucky and you'll pick one of the managers that did, in fact, end up beating the market. But nobody has figured out how to pick that person ahead of time, or that team. And in fact, the teams change over time. Managers of funds are hired and fired just like managers in the rest of the world. But here's the risk you take. It is one thing if you by chance ended up and you were having your money managed by somebody who did just a little bit better than the market, or maybe they just did a little worse. Maybe they underperformed it by 0.25%. But the dangerous thing is that many of the people who manage actively will underperform by an additional 1, even maybe 2, in some cases 3% a year over a long period of time. But when you know you have the choice and you can be in the fund that is going to look as close to the market as possible by doing nothing and charging very little, as opposed to the people who are fighting like cats and dogs trying to be the best. And it gets even better, because index funds have more diversification. And the academics tell us the probabilities of getting better returns come from more diversification, not less. And so, in the S&P 500, you hold 500 different companies. Actively managed funds normally only own 100 to 200 companies. More risk with fewer companies, and a high probability of lower returns. Now, the other thing is that because the index funds are not being traded. Now, sometimes they have to liquidate a position because somebody has sold a bunch of shares, and they have to give them the cash they have coming from that part of the mutual fund. So it's not like they never, ever sell, but very little. They call turnover. And when you have low turnover, what comes out of that is low taxation. And if you look at an actively managed fund in the large cap arena, that asset class of very large companies, is very common for the tax cost of owning that fund to be 1 to 1.5% a year in taxes. Whereas the index fund will typically have maybe 1/3 of 1%. They do get some dividends. So there are some taxes, but the bottom line is the index fund comes with a very low tax cost versus the actively managed funds. So then on top of that, when you own the index fund, you know exactly what you've got. You know exactly what you can count on in the future. You cannot count on those very same things with an actively managed fund. Bill Miller, for 15 years, ran a fund called the Legg Mason Trust Fund. For 15 years, it outperformed the S&P 500. I'm talking about 15 straight years. And the money, as you can imagine, just rolled in. Well, that's the good news. The bad news is for the next 10 years, they were virtually in the bottom 1% of all mutual funds in their category. They were terrible. Now, the academics would say that a lot of what they had in the first place was luck, obviously, good luck that first 15 years, and a lot of what happened to them in the next 10 was a matter of bad luck. It wasn't because Bill Miller wasn't just as smart as he was before, but it's a random event. I'm going to show you a what we call a quilt chart in the coming minutes here, and just show you how random the market really is over time, so that you will hopefully understand that you cannot have specific expectations for what kind of return you're going to get. I mean, you may have them, but there's no evidence that's going to have any impact on what you're going to get. So the index funds, lower tax costs, more diversification, lower expenses to run the operation, and an expectation to be in the top 10% for the rest of your life. I don't mean every year, but if you looked at the 20-year compound rate of return, you should likely be in that upper 10% of all investors. And that's a pretty neat place to be when you consider the fact that you don't have to do anything but find the index funds to put your money in. So I hope that one is loud and clear. And as you may not know the work that we do at paulmerriman.com, we do actually give you the names of the index funds we think you should use in your portfolio, whether you're at Fidelity or Vanguard or Schwab, and what we call best-in-class ETFs, other mutual funds. So I think at this point, we have easily found a way to be in the top 10% of all investors. We have found a way to minimize the expenses of getting into a fund and to having the fund operated. We have found the way of the path that means that we're going to be in equities instead of fixed income, particularly when we're young. I'm not saying you should be all equities all the time, but certainly in your 20s and your 30s, the case can be made, strongly made, that you should be virtually all in equities. But there's more. Now, the more means we're going to be nibbling around the edges. We're going to show you some ways that you might get an extra 0.5% because of the way you put your mutual funds together. Maybe a 0.5% because of the way you put your money into the market. Another 0.5% because you stay the course. We'll discuss those, but already in the first 6 steps, how probably to get your portfolio, even with modest investments over the years, into a Roth IRA or a 401k plan, but on your way to a multi-million-dollar retirement. And I, by the way, am not talking about doing all this for reasons of greed. No, I think it's for reasons of maybe having choices like retiring earlier. Maybe when you retire with more income. Maybe it's about leaving money to children and charities. There are legitimate reasons why it makes sense to try to take the right steps, the right paths, the right fork to make sure that you're acting in your best interest. You are number one, and I want to help you get there. Now, what I'd like to do is to show you kind of step by step how I think you can make an additional 1% on your investments, and I think you can make it without taking any more risk. I'll show you the studies, and I'll show you the history of 96 years worth of results to show you where this comes from and why I think that the return that you get will not expose you to additional risk. So here we go. We have talked mostly about the S&P 500. It is the granddaddy, the big poobah. It is the highest quality, most conservative index that we have in the United States. 500 of the largest companies. Now, it is not without risk, just because they're good companies and well known in most cases. If we look back at the equity index returns that we showed from 1928 to 2023, the S&P 500 had a year it lost. This is a calendar year that it lost 43.3%. So that's a big hit in a year, particularly if you've been saving for 39 years waiting to retire in the 40th year. But here's what I want you to see in that table, that when we look at other equity asset classes, like what it says on the table, USLCV, that stands for large cap value. You see, the S&P 500 is mostly growth, high-powered, successful growth companies, but it also has some of the more bricks-and-mortar type companies, what they call the value companies. They don't sell for high ratios, high price-earnings ratio. People aren't as excited to be in these companies, but they are often very good, stable companies. And it turns out that over a long period of time, those good, stable companies have created a slightly higher return than the S&P 500. And what the academics would tell you is that additional return came because there was more risk. And if you move further to the right on that table, you see a column that has a heading US SCB, Small Cap Blend. Small Cap Blend is mostly growth as well, but they're smaller companies. they're typically companies worth $2 to $3, maybe $6 billion. So they're not penny stocks, but they're not giants. They could be on the way up or on the way down, but they are smaller companies, public companies. But you'll see that for the $100 investment starting 96 years ago, while the S&P 500 grew at 10% and it turned into almost 950,000, that the large cap value grew to almost 2.3 million, and the small cap blend grew to almost 4.9 million. That was an 11.9% compound rate of return. And then there is the small cap value, SCV. It is the gold ring of these equity asset classes. Again, small companies, but companies that aren't hot small companies. They're not growth. They're out of favor. Their price to earnings ratio will be lower. And you can see that over the last 96 years, it has compounded at 13.2%. So the $100 grew to $14 million, almost 800,000. So these are all legitimate indexes. Yes, the S&P 500 is the one that people are most familiar with. But we also have on this table another column that says US 4 Fund. And that's a portfolio that is 25% in each of those four major asset classes. And $100 would have grown to about 4.3 million. The compound rate of return was 11.8%. Now, keep in mind, the S&P 500 was 10. So if the risk isn't much higher, if the volatility isn't higher, then you would think that picking up an extra 1.8% is a big deal. Now, I'm going to tell you that most people will do just fine if they got the 10% and knew they were in this very high quality index. I got it. But I'm just here to tell you that for people who have a little more risk tolerance, I think there's a lot more money to be made. It's not as different as the difference between bonds and stocks. I mean, once you've done that, you've done most of what you can do. But now we're trying to fine-tune the stocks. Now, I'm going to take you to what we call a quilt chart. And here it is. This is a quilt chart that each color represents a different equity asset class over the last 96 years, so that I can look at this and know that the S&P 500 is red. So I can look, let's say, just from 30,000 feet here for a second, and see that a lot of the time the red is at the top and a lot of time the red is at the bottom. Well, let me tell you what the academics tell us about the S&P 500. They will say that it should, over a long period of time, have a lower rate of return because it is less risky. Just like the bonds have a lower rate of return than the stocks because they are less risky. Just because the short-term bonds have a lower rate of return than the long-term bonds because they are less risky. But what is interesting here is 1 year at a time, the S&P 500 is on the bottom because in each year, starting in 1928, it shows the rank from the best return that year to the worst return that year. And sometimes the difference between the best and the worst it can feel like they're from different planets. I mean, the returns are so different, and yet this is the nature of the market. So let me make sure you get these colors. The electric blue is small cap value. And small cap value, that's the one that got the 13% return. In theory, it should be at the top most of the time. And yeah, it's at the top a lot of the time, but I don't know if I'd go so far as to say most of the time. And then there is the purple, that's the large cap value. And then with the green one is the small cap blend. And what you see here then are how these things randomly give returns. Now, yes, sometimes, like for example, from 1940 through 1945, the S&P 500 was very neatly along the bottom of the page, the bottom of those years. But when I look at let's look here from 1948 to 1957. It was at the top 6 of those years. 2017 through 2020, at the top 4 years in a row. Look at 2000 through 2006, 7 years in a row right at the bottom. Now, by the way, at the bottom isn't necessarily bad. It just means it didn't do as well as the others. Now, there is a fifth investment here you could make theoretically, and that is that you could put together a portfolio of the 4 different equity asset classes, and we call that the 4 fund, 25% each. What does that mean? It means you never get to be at the top. It means you never get to be at the bottom. And that you're going to find yourself hanging in around the middle. And the reason that becomes important is because being around the middle, not being at the bottom, not being at the top, not creating false expectations in the good times, not giving feelings of sadness in the bad times, it's in essence less risky than the S&P 500. And what we need to note is that if you decided to own all 4, and we look at the next table shows you that the U.S. 4 fund strategy, remember, never in the top, never in the bottom, but 78% of the time was right in the middle. Small cap value was 3% of the time right in the middle, 38% of the time at the top, 25% of the time at the bottom. The S&P 500, 28% of the time at the top, 41% of the time at the bottom. So remember when we talked about diversification and how it's smart to have many stocks in your portfolio? Well, what the academics tell us is that diversification amongst different equity asset classes is just as important as having a whole bunch of stocks in your portfolio. Because there will be times when the S&P 500 is in the top for a while and then in the bottom. And what you're looking to do in whatever return you get is to have it be in this particular portfolio, this 4 fund strategy. And I hope, going back again to that quilt chart that shows every year, if you want to really understand how the market is, you look at this table and you look at, for example, let's talk about the year 2001. Small cap value up 28.4%. The S&P 500 down 11.9. 1977, the S&P 500 down 7.2. Small cap blend up 22.8. There are many years that the difference between the top and the bottom is 30, 40, even 50% difference. And yet they're in the same market. And this is the strange aspect of investing, is that it just seems like the large go up and down together and the small go up and down together, and they revert to the mean, which means they'll do real well and then they'll come back down and then not do so well. And then sometimes they'll do poorly for a long period of time and then climb back up. But you don't have to go through all of that. And the way you don't have to go through all of that is to own parts of all four. So adding small, adding value, small value and large value, along with the S&P 500 and small blend, I think is going to make a really fine portfolio for you and your family. I have been around the industry since 1963, first as an amateur investor, and then in 1966, I was licensed to be in the securities business. And this next decision, this next $1 million decision, is a very difficult one to pinpoint. I can't show you a study. I can't show you exactly the meaning of sticking to one course or another. But I can tell you there are some people who can buy and hold what John Bogle called stay the course. And most people, actually talking about experts, believe that whatever portfolio that is reasonable, that you stay the course and you don't get somehow turned into a market timer and jump out of the market, that you're likely to get a decent return. Now, I am after more than a decent return for you, because the fact that we're focusing on low cost, there are people who pay high costs and they get a decent return. Well, if you're going to get a decent return, I want it to be the decent return that comes with low costs and low taxes and broad diversification and access to indexes and all of those things that we believe are in your best interest. But this next decision, buy and hold versus market timing, I really think that the odds of success for the long term are the highest if you can place yourself in a portfolio that you trust. Now remember, nobody knows what's going to happen in any portfolio after people invest. Nobody can see the future. And certainly, if they could, they wouldn't have been in the market on October 19th, 1987, because they would wanted to get out the day before and then not expose themselves to a 22% one-day loss. And they'd get back in. But nobody knows how to do that. Now, what happens is a lot of people have a sense of confidence or trust in an investment, the portfolio they have. And there's a reason they have a trust in it. Oftentimes it is not because they've seen a quilt chart and understand the random nature of the market and the value of diversification. No, what happened was somebody that they seemed to think was a pretty good person and seemed to understand and the investing process suggested that they do a certain thing. And as long as that thing is doing okay, then they stay the course. But all of a sudden, things happen, things that nobody expected. I mean, that's what the market's all about, is that It's the unexpected thing that causes the market to go up or down, not the expected. The expected is already priced into the market. So something happens, and it changes your sense of trust. And what you do trust at that point is just to get out, if you can, easily, and move into a position where you can have trust again. And oftentimes that means you get out of something that's falling and you're getting into something that is not falling. That would likely be a money market fund or something that doesn't have any volatility. And it's very common when we have major declines in the market that people get out, saying, I'm never going to do that again. And then they wait for years to get back into when they feel some sort of trust again and go through that same cycle. And so the idea of staying the course, of being a buy and holder, I think means that you really need to understand what you, in fact, are holding. Understand the nature of how it does on the upside and how it does on the downside. There are tables that we have that I'm not going to bore you with here today, but they show every combination of S&P 500 and bonds in 10% increments. They show the return 1 year at a time going back to 1970. They show the worst month, the worst 6 months, the worst year, the worst 3 years, the worst 5 years. They show information not just about the upside, but about the downside. And prepare people for that, because if you have expectations that this is going to be a nice ride, well, it really isn't a nice ride. It can be really very dramatic. And the goal is to take the drama out of it so that you will know how to stay the course through thick and thin. Now, that doesn't mean I want you to be all equities and expose yourself to the volatility of an all equity portfolio for the rest of your life. But I do want you to have enough knowledge of investing that you would know how much you should have in bonds to, in fact, address your need for return and your willingness to lose money. And there are tables. We produce them, other people produce them, and the attempt is to give you that knowledge that you need, so that this very random event will look very normal, because it will give you what you expected. Some good times, some bad times, some scary times, some happy times. And hopefully you just stay the course in that portfolio. But I don't want you to stay the course in a portfolio that has high taxes and low tax efficiency and high turnover, high expenses, all those things that are not likely to be in your best interest for the long term. So buy and hold versus market timing. The problem with market timing is you have to know when to get out. You have to know when to get back in and back out and back in. And the problem is that people don't have a clue what to look for to know when to get out and get back in. Unfortunately, the way that they know it's time to get out is because the market's gone down 30 or 40%. And a lot of people, I promise you, will be calling for the market to go down another 30 or 40%. And you feel like a chump sitting there and seeing your money disappear. And so you pull the trigger and you get out. So I'd like to eliminate that desire by you having reasonable expectations as to what the market is going to do for you and to you. Because if you get that part right and you control your expenses and you control your taxes and have enough equity to get the growth that you need and enough bonds if you're older to make things softer and more moderate in terms of volatility during the worst of times, you can do it. But you got to understand, I think you have to understand and have good expectations for what that ride is going to be like. And by the way, for young people, understand that when you are putting money into a 401k and the market starts going south, you should, particularly young people, celebrate the opportunity to buy more shares of very fine equity asset classes at reduced rates. So a declining market for a young investor can be an absolute blessing over the long term. So don't let those declining markets scare you out. What will often happen, I've seen this happen, is that a parent or a grandparent will be singing the blues about their investments, and it could make a younger person feel uncomfortable, like maybe they're doing something they shouldn't be doing. They should be getting out and trying to protect their money. No, it's just the opposite. The kinds of things that make old people like myself unhappy should make you very happy. So set it up so you're staying the course, expecting the bad times to happen, ready to celebrate the fact that you'll take advantage of those and keep on investing, and that you will not be a market timer and find yourself out of a great big bull market because you got scared out during a short-term decline. I hope you can stay the course. And in fact, John Bogle said the most important thing for investor success is that ability to stay the course. We are now at decision number 10. Now, this one is a little more difficult for me to put $1 million price tag on it. I know that this is the smart way to invest for people who are putting money aside for retirement, and that is to invest using dollar cost averaging. And it is basically what most young people are doing when they put money away for in a 401k, or if they're doing a regular investment monthly into an IRA. And the way dollar cost averaging works is you have a set amount of money, and it goes, let's say, monthly into the account to buy shares of the mutual funds that you're set up to buy. And maybe you have $500 going in, and maybe you have 5 different mutual funds that you put it into, and that it buys as many shares as that $100 will buy. And the way that it works in your best interest is that when markets are down, your $100 is buying, let's say, 10 shares of a $10 stock or fund. But let's say it goes down to $5. Now your $100 is buying 20 shares. Now, you don't want to do this with individual stocks because individual stocks themselves can go out of business. But for the S&P 500 or small cap value or large cap value or small cap blend, in the indexes, it is a really smart way to invest because it forces you to buy more shares when the market's down and fewer shares when the market is up. and it takes you out of the mode of wanting to make the call when the right time is to invest. I'm sure there are lots of people that accumulate cash and they're waiting around. They're in essence market timing. But dollar cost average is a kind of market timing. It is absolutely automated. It takes all of the emotion out of the process and does that is guaranteed to be in your best interest for the long term. Of course, taxes are a big, big deal. And one of the challenges, just like we don't know what returns will be for future investments, but we also don't know what taxes are going to be. I know when I came into the business that the highest tax bracket was 70%. Just a couple of years before I got in the business, it was 90%, which means people who were making high incomes were paying most of what they made out in taxes. It's interesting that the economy still continued to roll along and the markets went up and down, and it certainly isn't what we would picture, but now we picture much lower taxes. But it's obvious that with the deficit building to many, many trillions, that it is certainly possible at some point that we will have to pay higher taxes in order to make up for the past. Anyway, we can take steps as an investor to manage the likely outcome of taxes. And in a sense, we can pay taxes now or pay taxes later. Let me just give you an example. And I'm not going to try here to cover all the tax bases. We'll have somebody else, I'm sure, that will talk on that. But I want to focus in on what I suspect will apply to most of the people who will watch this work. And that is the use of the Roth 401k or the Roth IRA. Now, if you are working for a company, more than likely you're going to have a 401k available to you, and maybe the company will match part of what you put in. Now, you certainly don't want to miss the match because, in essence, that is money that is going to not only be given to you for having put money into the account, but it will then compound tax deferred for the rest of your life until you take the money out. And there are, of course, ways that you can convert that money, pay some taxes now, and convert it into a Roth. But it's important to know that difference between the Roth and the traditional 401k or the Roth and the traditional IRA. Now, the IRA, for example, means that when you do the traditional IRA, you will be able to deduct that investment from your taxes, your taxable income, and that will reduce your taxes by some amount, which means in theory you could get a refund. And then that money compounds in that traditional IRA on a tax-deferred basis for the rest of your working career. And when you start taking money out, you will have to pay taxes on that money at the highest tax rate at that time in your life. So, what's the better decision? Well, you see, when you do the regular traditional IRA, you get that refund. Now, there's a fork in the road with what you do with that refund. Do you pay some bills? Do you go out and have a party? Do you go on a trip? Or do you reinvest it? Now, in essence, what you've done with a Roth IRA is you have automatically reinvested that tax. You are not getting that tax refund. And in exchange for you not getting that tax refund, the government says that that money can not only compound tax-free until you start taking money out, but at the time you start taking the money out, it comes out tax-free. And if you still have money in there when you die, your heirs can, over a number of years, take that money out tax-free. Now, right now, that's 10 years, but who knows what tax laws will be like 20, 30, 40 years from now. So, for giving up that refund, you have the opportunity to have that money tax-free for the rest of your life. And I got to tell you that I think the odds are very high that we will have much higher taxes in the future. And so to protect that money from taxes, I think would be a very smart thing to do. Now, it may be that tax laws will change, and it'll turn out that it wasn't the smart thing to do. Some people actually kind of like to have it half traditional and half Roth, so that you've got kind of a diversified approach to how you take that money when you get there. And by the way, the other nice thing about the Roth IRA, at least today, is that when you are in your 70s, you do not have to start taking required minimum distributions. You can just leave all that money in there to grow. Now, in my particular case, I chose not to do the Roth IRA because at my death, all of my IRA goes to charity. So there's no real advantage for me to have tried to shelter that from taxes. So that is one big decision. And that decision goes with 401ks. Not all 401ks have a Roth offering, but some do. And so taxes can be a big part of the process. Again, I'm not going to go into a lot here on taxes, but I just want to tell you that when you are young, in particular, when you are not at a very high tax bracket, it is certainly in your best interest to get that money put away into a Roth because of the long-term tax implications. And remember, as we talked about earlier, those early years, when those early years are able to compound for 50 or maybe even 60 years before you start using it, it's just golden that you don't have to pay any taxes on those contributions. The 12th, in many ways, the biggest decision of all. And for many of you, if not most of you, it will be the decision that will, in fact, take care of almost all of these decisions all at one time. And that is the target date fund. I mentioned earlier that mutual funds first became available in the 1920s. And they were a huge breakthrough for the public because now they could buy a diversified portfolio and invest like a rich person. And then really many decades later, the next huge new product was the index fund. And I've talked about that as well. And it brings you lower expenses and less in tax obligations and more diversification and more control and a higher probability of success than any fund that was ever created. And then we keep making the index funds better. That was great. But in 1993, a brand new kind of fund was created. And it was exactly what the majority of people wanted. It allowed you to manage the internal portfolio like indexes, and it held mutual funds. So you could have the index mutual fund in your portfolio. What was added? That the managers were managing to a particular age bracket with a goal to retire in a certain year. So many first-time investors today are likely saying they would like to retire in 2065. And the 2065 target date fund is managed knowing that that person is young today. Now, you could fool it, and you could invest in the 2065 fund when you're 80 if you want to, but that's not the problem for the people who manage it. They have to manage it with an understanding that the investor is young, should be taking more risk, and as they get older, eventually will add the fixed income to stabilize as you get closer to retirement. So it is all of the things that a pension trustee would do to make sure that somebody who is saved, money's been put aside to fund a pension at retirement, they in essence do a similar kind of thing. And that is to manage with the risk tolerance of what that person should be. Now, in many cases, the person is afraid to take any risk because they don't know what they're doing. But if they believed that the people who were managing knew what they were doing, they would be okay with that. They would allow that to happen. But they recognize they don't have the ability to do it. So now with target date funds, somebody who's going to work for the first time, putting their first dollars into their 401k plan or their IRA, can use a target date fund and never, ever have to worry about how it's being managed, because it is being managed with your age and the risk needs, the return needs that you likely have. The responsibility the investor has is to put the money in there. That they won't do for you. But if you put the money in, they will manage it. And over half of the new money that's going into 401k plans are going in to target date funds. You see, if you don't use target date funds, it means that you think you know what the right thing is to do, and that you can do it better than a target date fund. Well, Warden did a study of 1.2 million 401k accounts at Vanguard, and they tracked people who didn't have any target date funds, and they tracked people that had nothing but target date funds. And what they found, boy, is this important. The people who had target date funds had an expected rate of return of 2.3% more annually. Now, I told you early on, if I could figure out how to show you how to make an extra 0.5%, it could be life-changing. But the target date fund, it's not perfect. There are things about it that make it less than what I would like. And in fact, in the free book that you can read, we're talking millions. Half of the book is about target date funds and what you can do with just a little tweaking to make them extra special. But without the tweaking, you could do just fine. And they are the investment that 99% of young people should be going into, because you got people who are really experienced managing that money. And if you get into a target date fund that underneath the umbrella of the fund they're using index funds, bravo. And that would not only mean that you'd have more diversification, but you'd have lower expenses. And in fact, the expense ratio, the cost of managing the target date fund at Vanguard is 0.08%, which means that it's pretty doggone close to free. And so, remember I mentioned when I went into the business back in the 1960s, that mutual funds were getting 1% and more to do the managing. Well, think about having some of the best management in the world and being charged less than 1/10 of what people had to pay when I started investing. So I think the Target Date Fund is an amazing product. Chris Pedersen will be talking about that in one of our presentations and let you go deeper into how they work. But I just wanted to mention them here because they certainly are one of the $12 million decisions. Because if you go the route of the Target Date Fund, not only do you get professional management and do you get professional management with index funds that have low expenses, but you have managers who will manage it professionally for the rest of your life. You will never, ever have to talk to a commission salesperson trying to sell you a load fund or trying to sell you an actively managed fund. Now, be careful, because there are target date funds that are actively managed. I'm not putting my stamp of approval on them, but they are out there. And normally they come with much, much, much higher expenses. So I hope you will listen to Chris Pedersen's piece on target date funds. And I hope you will read We're Talking Millions. And oh, by the way, I'll give you a heads up right now. Another free PDF book that you can get is entitled Two Funds for Life. And the author is Chris Pedersen. So what is an investor to do with all this information? But let's remember what this is supposed to be about. The idea is to give you the information that makes it possible for you to be able to do the investing yourself, to cut out all of the middle people that are going to take a piece of what could be in your financial future instead of theirs. So I think it's important to remember that each of the 12 forks in the road that I tried to take you to and give you the choice whether going to the right or the left was going to be in your best interest. And what I know is that in almost every case, there is an overwhelming amount of evidence of what is in your best interest. And remember, just 0.5% additional return over a lifetime is likely worth over $1.5 million, even to people who are not investing a lot of money. Now, you may have doubts about my recommendations. You may think they are colored by something that has to do with me being obligated to somebody else instead of to you. But here's what I think you ought to do. You can go to ChatGPT or some AI source. You can go to Google and do a search. And you could ask about, if you wanted to, each one of these forks in the road. And then you can do your own digging in terms of, what would have given you the best return. For example, it seems pretty easy or acceptable to believe that if you save, you're going to be better off than if you don't save. That's an easy one. Is it $1 million payoff? Yeah, I believe so. Why would somebody, by the way, not save? Why would they think that they would do better not putting that money away for the future? Well, one, you could have a belief you're going to win the lottery. Another might be that you have the belief that you are going to inherit enough money that you don't have to worry about saving. But other than a few relatively unusual situations, my sense is the big payoff comes from saving, and it comes from saving early. And I think it's pretty clear from the past that stocks have been better than bonds for the long term. And I think it's pretty clear that you are going to be much more likely to survive and thrive if you have a portfolio of many stocks, not just a few. And this is a very common mistake that young investors make because they think they're going to get rich quicker by just picking out a couple of great companies. Unlikely. Then there's the question, if you are going to have many stocks, are you going to have the mutual funds pick them for you, or are you going to select them? Well, I'm just telling you that I've been around this business for almost 60 years, and I am not qualified to put together a portfolio of individual stocks. My portfolio, or the portfolio, I should say, for my wife and myself for our retirement, all in mutual funds. And the fork in the road, no load versus load. Pay a commission or keep it in the pool for you to benefit from it. And then you're going to have to make the decision, mutual funds with high expenses or low expenses. Remember, I'm always sensitive to something that's grinding away at you at a rate of 1/4% or 1/2%. In some cases, it can be a whole 1%. And then you have this huge lifetime decision. Are you going to, if you want to invest in stocks in a diversified portfolio and you want to do it through a mutual fund, are you going to use the fork that takes you to the index fund or the actively managed fund? Again, the evidence is overwhelming. In fact, the hope that you would have if you choose the actively managed fund is that you will be able to pick the 1 out of 10 or 1 out of 20, it depends on what asset class you're talking about, but that you will be able to spot today the small percentage of funds that will do better than the indexes over the next 20, 30, 40 years. Good luck. And by the way, if you did nothing but use the S&P 500 or the total market index as your equity position, I'm sure you'd be just fine. But the academics have opened up the fork that leads us, suggests that we should have some portion of our equity portfolio in smaller companies and in value companies. And so, as you may remember, there was an extra long-term return. And in any of these cases where we talk about return, I can tell you that when an expense is 0.1% every year and another fund is 1% every year, I can tell you what's coming. That one fund is costing you 90 basis points of your return, 90% of 1%. And that's a given. What we don't know is how the fund itself will do. So that one, you don't need the small, you don't need the value. I'm just telling you, in my own portfolio, I have a healthy chunk of both small and value. And then there's the decision, are you going to buy and hold, or are you going to play the market? Are you going to market time? Are you going to decide there are times to be in and times to be out? And I'm just telling you, I've been around this business for 60 years, and I have rarely met somebody who accomplished with market timing what they were trying to do, because it turns out for most people that market timing is an emotional decision, and that is almost never helpful when you're an investor. And then there's the decision, do you dollar cost average into whatever funds you're going into? Or in other words, just put the money in there every month. You put the $500 and it buys as many shares as it can. And when the market's down, it buys more. And when the market's up, it buys less. Or do you want to hold your money back and wait until the timing is right? And then you have the choice between putting your money somewhere where there are tax advantages galore, like no taxes from now until retirement on the money that you make. And then you retire and you start taking the money out, and there are no taxes on the money you take out. And then you die and you leave the money to your kids, and there's no tax if they take it out under present tax law within 10 years of your death. And finally, there's a fascinating decision that you could make, and that is to decide, forget about all of this stuff and picking that fund or when to get in or when to get out or any of that, and you put your money into a target date fund that takes care of everything for you for the rest of your life. And I mean that. Until the day you die, they will manage with the appropriate amount of equities, the appropriate amount of fixed income. So they'll be more aggressive when you're young. They'll be more conservative when you're older. But they will do through their eyes for you for no extra fee. Management of the funds. And I don't want you to forget this study. The study that Wharton did that showed that people who use target date funds had funds that were built to make about 2.3% better per year than the people who were doing it on their own, trying to kind of guess when to be in or out of the market, or trying to guess what kind of mutual funds are likely to be better for the next year or two or whatever, trying to micromanage the investment. So if you did nothing but put your money into a target date fund, I think you'd be making a very fine decision. So that's what this presentation is about. Trying to help you make some decisions as a do-it-yourself investor that will serve you well for the rest of your life. And to the extent that you hire other advisors to help you with that, understand they have to go through this same process. So if they're not using index funds, I'm wondering who they're working for. If they're selling you load funds and then charging you some sort of a fee to take care of you, why aren't they using no-load mutual funds? I mean, the same questions are going to have to be asked. But I do wish you well, and I truly appreciate your interest in this topic, and I hope as you listen to the other presenters in this special series that you will find ways to strengthen your ability to improve your financial future. Thank you, and good luck.